Let's get started with financial accounting. First, let's talk about what accounting is. So, and what its purpose is. The purpose of accounting is to identify, measure, and communicate economic information about a particular entity to interested users. And so we'll come back to this concept several times. But we want to talk about some assumptions that are necessary. And so these are going to be underlying assumptions that we will rely on throughout our study of accounting. These assumptions are necessary in order to get through this process of accounting. So our four key assumptions are: number one, the economic entity. And so this assumption states that the financial activities of a business can be separated from the financial activities of the business's owner. So it's a separate kind of standalone entity apart from its owner. Second is the time period. And so this time period assumption assumes that the economic information that we're drawing can be meaningfully captured and communicated over short periods of time. So typically months that we then aggregate into quarters and years and so on. Number three is the monetary unit assumption. Here we assume that the dollar, the US dollar, is the most effective means to communicate economic activity. And then finally, the going concern assumption assumes or states that a company will continue to operate in the foreseeable or into the foreseeable future. So we don't think that they're going to go out of business anytime soon. So now let's move on and talk about profitability, which we will find on the income statement. So one of the first questions that any business is asked is whether or not it's making money. And so stated differently in accounting words, this means, is the business profitable? Does it generate more revenues than it's actually using in terms of expenses? So accounting provides answers to these questions with a financial statement that's called the income statement. So an income statement reports a company's revenues and expenses. So an income statement reports revenues and expenses, as we just mentioned, and there are several important terms and concepts that we need to go through when talking about the income statement. So first, let's talk about expenses. Expenses are decreases in resources resulting from the sale of goods or services. Second, is this matching principle. So expenses are recorded according to the matching principle, and what that principle states is that expenses should be recorded in the period that the resources were used to generate those revenues. Number three is revenues. Revenues are increases in resources resulting from the sale of goods or the provision of services. And then lastly, the revenue recognition principle. This principle states that a revenue should be recorded when a resource has been earned. So we've got two very important principles here, the matching principle and the revenue recognition principle. So now let's take a look at the basic structure of the income statement. Very simple. Revenues minus expenses are equal to the net income. Or if it's negative, that would be a net loss. And so it's reported over a specific period, like a year or a quarter or a month. So typically we'll be looking at a year's time. So it may say the income statement for the year ended December 31st of whatever year. That's assuming that the entity is reporting their financials based on a calendar year. So here's an example. So this is the income statement for Lawn Service Inc. for the month ending June 30th. You see their revenues, you see their expenses, and then the revenues minus total expenses give us net income.